Welcome to This Explainer. Today, we're looking at a fascinating, honestly kind of unbelievable shift happening right now in the corporate world. We've all seen the headlines over the last couple of years, right? Artificial intelligence was supposed to be the ultimate cost saver, a miraculously cheap alternative to human labor. But a very strange and totally unexpected financial reality has suddenly emerged. We're talking about a phenomenon I'm calling the token trap, where the exact same technology that was brought in to ruthlessly cut costs is suddenly bleeding corporate budgets completely dry.
Okay, let's dive into this. The big question on everyone's mind, and honestly the absolute panic echoing in every corporate boardroom right now, is this. How on earth did AI end up costing more than the workers it actually replaced? I mean, it started out as this cost-saving miracle that justified massive corporate restructurings, but somehow it's morphed into a giant financial burden that companies are really struggling to maintain. Whether you're an investor watching your portfolio, a tech employee navigating the market, or a business owner, this reversal is going to impact you directly. To understand this incredible pivot, we really need to trace the timeline and uncover the hidden economy of AI tokens. Section 1. The cheap AI promise and the 2022 to 2024 tech bubble. Let's rewind just a little bit to remember the initial allure of this technology. Back in 2022, when ChatGPT first hit the market, the growth was just breathtaking. Suddenly, AI could generate code, create hyper-realistic images, and seamlessly handle all these complex, time-consuming tasks. To corporations, it looked like a total silver bullet, an incredibly cheap, highly efficient way to scale their operations without scaling their payrolls. And things escalated incredibly fast. In 2022, ChatGPT launches and reshapes the landscape. By 2023, we see mass corporate AI adoption. Companies are racing at unprecedented speeds to incorporate these tools. And then 2024 brings the dark side of all that adoption: mass worker layoffs. Tech giants like Amazon, Microsoft, Meta, and even fast food chains announcing AI drive-thrus began ruthlessly cutting jobs. AI was wiping out roles across industries because executives firmly believed it was drastically cheaper to maintain than a human workforce.
The dominant, completely euphoric corporate sentiment of that era was basically this: it could do the work of 10 people at 1/10 of the price. Or, at least that's exactly what everyone was telling themselves. The belief was so absolute that companies didn't just encourage AI use. Starting in 2023, they essentially forced their employees to use it. This aggressive push to replace entire human teams really set the stage for an explosive, totally uncontrollable growth in the demand for these AI models.
Section 2. The token maxing trap. How engineers gamed the system. All right, here is where the massive complication begins. Companies needed a way to track all this new AI efficiency and justify their huge investments, right? So they started measuring employee performance and usage through something called tokens. But they inadvertently created a system where burning through these digital tokens became a bizarre and incredibly expensive metric for employee success. You absolutely need to know the term for this: token maxing. It's the practice of employees excessively using AI tokens for completely insignificant tasks simply to artificially inflate their performance metrics. Using a huge number of tokens became an actual status symbol. Employees wanted to prove they were going above and beyond to hit their KPIs. So, by the end of 2025, software engineers were using AI for practically everything, essentially gaming this invisible economy just to appear more efficient to management. Listen to this executive mindset, because it brilliantly highlights the absurd Silicon Valley culture that drove this exact behavior. Executives were literally saying, if that $500,000 engineer did not consume at least $250,000 worth of tokens, I am going to be deeply alarmed. No joke. We even saw industry leaders strongly encouraging developers to juice these numbers. Engineers were literally being scored on a leaderboard for their token usage. This culture directly incentivized an artificial, massive inflation of AI demand that had absolutely nothing to do with real, necessary enterprise work.
Section 3. Exploding AI budgets. The math catches up.
So, all that token maxing and artificially inflated demand, it created a totally fragile house of cards. This massive adoption worldwide slammed headfirst into physical reality, triggering tech stock sell-offs and leading to crippling financial consequences for the very companies that thought they were outsmarting the system. Get this, according to Bloomberg, nearly 50% of all data center construction projects planned for 2026 in the US have been canceled or delayed, Why? Because the massively inflated demand from token maxing caused severe shortages of the electronic components actually needed to build these data centers. The infrastructure simply could not keep up with the artificial demand. This physical bottleneck became a major crisis that rippled through the entire tech sector. Now, what's really interesting about this slide is how these infrastructure bottlenecks directly impacted the fundamental price of AI. Notice the rising costs here for large language models. In December 2025, the average cost per million tokens was $1.11. By May 2026, just 5 months later, it had nearly doubled to $2.12. And when you factor in the sheer volume of tokens being consumed by massive corporations, this seemingly small increase translates into tens of millions of dollars in unexpected monthly expenses. To really grasp the staggering scale of this problem, consider this number: 8 billion. That is the number of tokens AT&T reported consuming every single day. Let that sink in. If an average employee uses just $200 worth of tokens a week, a company with 90,000 employees is suddenly staring down a $900 million annual expense. The scale of this daily consumption across enterprise companies is absolutely astronomical and, honestly, highly unsustainable. Of course, this corporate panic has been wildly profitable for the AI providers themselves. Look at Anthropic's projected annual revenue. It is absolutely skyrocketing. They ended 2025 with around $3 billion in revenue, but thanks to this frantic enterprise AI adoption, they aim to nearly triple that to $9.6 billion in 2026. The budgets are rapidly flowing straight out of enterprise tech companies and directly into the pockets of AI leaders like Anthropic and OpenAI. But the sheer financial pain for these tech companies is becoming impossible to ignore or hide. $900 million. That is the estimated cost of Meta consuming nearly 60 trillion tokens in just a single month. 1 month. It's reaching a point where top executives can no longer justify the expense to their boards. The AI bill has finally come due, and major corporations are literally blowing through their entire annual AI budgets in a matter of weeks. Which leads us to this incredibly ironic moment. Microsoft, an absolute pioneer and massive investor in AI, literally banned its own employees from using certain AI coding tools like Claude due to the massive token costs. The expense of using these top-tier models these days is being compared internally to driving a Ferrari, when even Microsoft has to start canceling software licenses for its own engineers because it's simply too expensive to run. You know for sure the financial model is fundamentally broken. Section 4. Tokens versus humans, the ultimate corporate choice. We are now witnessing a massive corporate scramble, and the situation is critical. The rapid evaporation of AI budgets has forced a brutal reckoning across the business world. Companies are facing a choice today that nobody ever thought they'd have to make when this whole revolution kicked off. Annual AI budgets are being blown through in weeks. Global enterprise AI spending is projected to hit a staggering $680 billion by 2027. Because of this, massive players like Uber and Microsoft are actively scaling back their aggressive AI adoption. Corporate finance departments are finally waking up and seriously questioning the true return on investment. They're starting to realize that these AI agents now cost as much as, or sometimes even more than, the human workers they fired in the first place. And this brilliantly illustrates a highly nuanced new reality businesses are discovering. It's no longer a blanket statement that AI is just cheaper across the board. While AI undeniably wins out on things like heavy coding tasks, human labor is actually proving to be much more cost-efficient for operations like call centers. The current cost of running AI agents in those specific spaces can clearly exceed the cost of just keeping human employees. And all of this builds into an even larger impending crisis. Step 1, AI leaders like Anthropic and OpenAI are expected to go public in the coming months. Step 2, once they're public, they're going to face immense investor pressure to achieve actual profitability, because right now they're operating at a massive loss. The token prices we see today are heavily subsidized by generous funding. Step 3, to generate those required profits, those subsidized token prices will inevitably multiply exponentially. The costs haven't even hit their peak yet.
So the crucial point is this provocative final question. When AI models go public and inevitably raise their prices to satisfy their new shareholders, will businesses be forced to rehire the very workers they laid off? It is the ultimate ironic twist in the corporate AI revolution. What started as a ruthless mission to replace human labor with a cheaper digital alternative might just end with companies realizing that humans were the more cost-effective choice all along. Thank you so much for joining me for this explainer, and I really hope it gave you a totally new perspective on the true cost of AI.